For most people, a savings account feels like the safest place their money can be. You deposit your income, watch the balance slowly grow, and feel reassured knowing your money is protected. The bank even pays you interest, which makes it seem like the bank is doing you a favor for keeping your money there. But the truth is far more interesting. A savings account is not just a safe place for your money. It is one of the most profitable tools banks have ever created. When you put money into a savings account, it feels like you are storing it. In reality, you are lending it. The moment your money enters the bank, it no longer legally belongs to you in the way most people think. It becomes the bank's asset, and you receive a promise in return. That promise is that you can withdraw your money whenever you need it. This simple shift in ownership is the foundation of how banks make money from your savings. Banks exist to borrow money at low cost and lend it out at higher rates. A savings account is one of the cheapest ways for a bank to borrow. When a bank pays you 2 or 3% interest, it is paying a very small price to access your funds. That same money is then used to issue home loans, car loans, business loans, and credit lines at much higher interest rates. The difference between what the bank earns and what it pays you is profit. Imagine depositing $100,000 into a savings account. The bank might pay you a few $1,000s in interest over an entire year. Meanwhile, that same money could be part of a mortgage or business loan, generating several times that amount in interest for the bank. Your money is active, moving through the financial system, creating income every day. The only difference is who benefits most from that activity. This system works because banks understand human behavior. They know that most people will not withdraw all their money at once. Salaries come in, expenses go out, and balances fluctuate, but the majority of funds stay deposited. Using decades of data, banks can predict how much money will remain available on any given day. This allows them to lend out a large portion of deposits while keeping only a fraction available for withdrawals. This is known as fractional reserve banking, and it is one of the most powerful mechanisms in finance. It allows banks to use the same pool of savings to support many different loans at the same time. One deposit can effectively fuel multiple streams of income. While this system supports economic growth, it also dramatically increases how much banks can earn from your savings. Interest spread is only part of the story. Fees are another major source of profit. Many savings accounts come with maintenance charges, minimum balance penalties, withdrawal limits, and service fees. These fees are often small enough to feel insignificant, but across millions of customers, they generate enormous revenue. Even banks that advertise no-fee accounts often recover income through indirect charges or bundled services. Banks also benefit from how interest is calculated. Loan interest is often compounded frequently and calculated on outstanding balances. Savings account interest is usually lower and sometimes calculated less often. This timing difference allows banks to earn more on your money before they ever pay you interest. Over time, this gap quietly widens. Another important factor is inflation. While your savings account earns interest, inflation reduces the real value of your money. In many cases, the interest paid by banks does not keep up with rising prices. This means that even though your balance increases, your purchasing power decreases. Banks benefit because they repay you with money that is technically worth less than when you deposited it, while having used that money to generate real returns. Trust is what makes this system possible. Banks are seen as stable, regulated institutions, often backed by government guarantees. This trust encourages people to deposit money without demanding high returns. Customers accept low interest rates in exchange for safety and convenience. Banks leverage this trust to access massive pools of cheap capital. Savings accounts also act as gateways to more profitable products. Once a customer opens an account, they are more likely to take loans, credit cards, insurance, and investment products from the same bank. These services often carry much higher profit margins than savings accounts themselves. The savings account anchors the relationship and keeps the customer within the bank's ecosystem. Data plays a role too. Banks analyze how customers save, spend, and withdraw money. This information helps them design better products, assess risk, and target offers more effectively. While individual accounts seem insignificant, collectively they provide valuable insight into consumer behavior. This data-driven approach improves profitability across the bank's entire operation. Scale is another key advantage. A single savings account may not generate much profit on its own, but millions of accounts create enormous income. Banks operate on volume. Small margins multiplied by massive numbers result in substantial earnings. This is why banks aggressively promote savings accounts, even when interest rates are low. Digital banking has increased efficiency even further. Online accounts reduce operational costs, require fewer staff, and minimize physical infrastructure. These savings allow banks to keep more of the profit generated from deposits. Technology hasn't changed the fundamental model. It has simply made it more efficient. From the bank's perspective, the ideal savings account customer is one who deposits money regularly, rarely withdraws large amounts, and does not question interest rates. Inactivity is not a problem. It is an advantage. The longer money stays deposited, the more opportunities the bank has to use it elsewhere. None of this means banks are acting unfairly. This is the system as it was designed. Banks provide liquidity, security, and financial infrastructure. In exchange, they profit from managing money at scale. The issue is not exploitation, but awareness. Many people simply do not realize how valuable their deposits are to banks. Understanding how banks make money from your savings account changes how you think about money. It highlights the difference between storing money and growing money. A savings account is excellent for safety and access, but it is not designed to build wealth. It is designed to support the banking system. Your savings account is not a vault. It is a loan, a quiet, low-interest loan you give to the bank. The bank then uses that loan to generate far greater returns through lending, investing, and financial operations. While you see a small increase in your balance, the bank sees a powerful source of profit. And that is how banks make money from your savings account. Not through obvious charges or hidden tricks, but through a system that turns your need for safety into one of the most reliable profit engines in modern finance.